So now we understand this relationship. Net operating income divided by selling price gives us the rate of return. And we're going to need that as we work through and figure out the rate of return of comparable properties so we can apply it to a subject. But very importantly, we need to understand, first of all, where do we get net operating income from? What does that mean, net operating income? Well, think about any building, commercial or residential. If you're an investor looking at this building, you'd ask yourself, what is the absolute most I could squeeze out of this investment? What is the best case scenario in the world? And as a landlord, the best case scenario is you are getting current market rents, and it is maxed out. 365 days a year, it is completely rented out. So this is the absolute maximum potential of this building, and it's what we call the gross potential income. Current market rates, assuming that it's rented out every single day of the year. Gross potential income. Wonderful. But you have to be realistic, and you have to understand that, look, that's the absolute maximum that we could get, but there's going to be vacancies. You have to assume that over a period of time of owning this property, at some point, somebody's going to leave early, or we'll have trouble finding a tenant. Whatever it is, there's going to be vacancies. Typically, we state vacancies on a percentage basis. It's an estimate, percentage-wise, of how much we think we won't be able to rent out this property during any given year. What's different about vacancy rates compared to rental rates is we use a long-term estimate for vacancy rates. Vacancy rates can spike up and down in the short term, so we want a bit more of a consistent average sort of on a long-term basis. So we'll take the gross potential income, which is based on current rates, and we'll subtract off an estimate for vacancies based on a long-term estimate. That gives us what we call gross realized income. It's a realistic estimate of what we can expect to get renting out this property. But remember, that's just from the rents. So we have to run this building. Whether it's a commercial or residential building, we're going to have costs. Well, have to pay property tax if I'm the owner of this building. There's probably electrical costs for common areas or things like that. And I'm going to have to maintain this building. So we call these costs operating expenses, or OPEX for short. So the operating expenses are the direct costs of running this particular building. So they're not to be confused with costs of running any other investment I have, or maybe my head office. Imagine I'm a big real estate investor and I have many real estate projects. Well, then I probably have an office and staff, but those are what we call administrative costs or overhead costs. When we're looking at running this building to figure out its return, I just want to know the costs of this building. So operating expenses do not include three very common costs that they might try to trap you with on this exam. They do not include income tax, because income tax is related to my global or full operations. They don't include depreciation, because that's not a real cost in the sense that it's costing me money, cash flow out the door. It's an estimate for the usage of these properties. And they also don't include interest. If I've borrowed money to buy this project or any other project, that was a decision I personally made as an investor. It's not directly impacting this project, as in somebody else could go out and buy it completely for cash and then they wouldn't have any interest costs. So interest costs, depreciation, and income taxes are all what we call administration or overhead expenses. So they're not included in an estimate for operating expenses. What is included is an annual estimate for maintenance. So you have to consider, if you own a building, early on in the life of this building, you're probably not going to spend a lot of money relatively on maintenance. But after 5 years, you might have to replace the carpets. And maybe after 10 years or 15 years, you might have to replace a water tank or boiler. And maybe after 20 or 25 years, you have to replace a motor and an elevator. And after 30 or 40 years, you have to do some major maintenance on the roof. So it's not that the 30th year was any more expensive than the first year. It's just that these costs build up over time. So what we do is make an annual estimate by taking a total cost of running this building and dividing it by the number of years. But just keep in mind that OPEX includes this annual estimate for maintenance because we know we're going to have to spend this money. What we're doing here is what we call income smoothing. We're just trying to figure out what an average income would be over this period. We know that income is going to go up or down because in those years we really spend the money, we're going to earn less. But on average, how much are we earning each year? So the process of getting to this net operating income number that we've been talking about is pretty straightforward. Start with the maxed out potential, gross potential income. Subtract off an estimate for vacancies, and then subtract off the cost of running this building. It's just a 1, 2, 3-step approach. Gross potential income minus vacancy minus operating expenses gives us the net operating income that we need. And that's how we're going to typically go forward in these examples. In the next video, we're going to do exactly that.